diving in deep today. We're going deep with, Philip Sisher's Common Stocks and Uncommon Profits. This book, it came out way back in '58, but the stuff in here, it's still so relevant today.
Oh, absolutely.
We're
Timeless.
talking about finding those companies, the ones that have that like crazy potential
Yeah.
that could just explode in value.
Yeah, the kind that turn into those household names.
Exactly.
Yep.
And Fisher, he seemed to have this knack for spotting them early on, like Alcoa, Dow Chemical,
Motorola, Texas Instruments, yep.
huge winners. So what was his secret? What can we learn from this guy, to help us make better investment decisions ourselves?
Well, one of the things that really sets Fisher apart is his emphasis on what he calls scuttlebutt.
Scuttlebutt, okay? Sounds a little, I don't know, gossipy for investment strategy.
Yeah, it's not your typical Wall Street jargon, that's for sure. But think of it more like detective work, going beyond just the numbers, the financial statements.
Okay. So digging deeper.
Exactly. He believed that to really understand a company, you got to talk to the people who are actually in the trenches.
The insiders.
Yeah, competitors, suppliers, customers, even scientists and industry experts.
So it's like getting the inside scoop, the stuff you wouldn't find in a fancy report.
Exactly. He believed those conversations could reveal insights that you just wouldn't get from reading reports.
So like what kind of insights are we talking about? Did he have any specific examples of how this scuttlebutt thing actually worked?
Yeah, he actually shares this great anecdote in the book about a university. They were actually advising their graduates, like straight up telling them, don't go work for this one particular oil company.
Wow. Harsh. What was so bad about this company?
Well, through his scuttlebutt, Fisher found out that this company had a really bad reputation for basically mishandling research projects. They'd start these projects and then abandon them like before they were even finished.
Oh, so it was a lack of commitment.
Right. And the university saw that as a major red flag about the company's commitment to innovation, which, for Fisher was a huge deal.
That's pretty insightful. You'd never find that kind of information just, by like reading their annual report. But wouldn't gathering this kind of information be tricky?
It can be, for sure. There are definitely ethical considerations.
Yeah.
I mean, confidentiality, you don't want to get anyone in trouble.
Right.
Fisher was very clear about that. You have to be discreet, assure your sources that you're not going to, reveal their identities.
Protect your sources.
Yeah, exactly. And be mindful of the information you're seeking. Not everything is fair game.
Makes sense. Okay, so you've done your detective work, you've gathered all this scuttlebutt. How do you then actually go from that to like figuring out, all right, is this a company I should actually invest in?
That's where Fisher's famous 15 points come in.
15 points?
Yeah, he laid out this set of criteria that he believed signaled, exceptional potential.
So it's like his checklist for amazing companies.
Exactly. And the interesting thing is these points are still incredibly relevant today, even though, he wrote this book decades ago.
Timeless, right? Okay,
Yeah.
so let's dive into these 15 points. What are some of the key things that he was looking for?
Well, one of the most fundamental ones is market potential. It's not just about how big the market is right now, but how much room there is for growth in the years ahead.
Future potential. He uses the example of Alcoa, the aluminum company,
Yeah.
right? Which, obviously became incredibly successful.
Yeah, exactly. Fisher, he recognized that Alcoa was like perfectly positioned to benefit from the rise of air travel. Back then it was just starting to take off.
The industry was growing.
Yeah.
Yeah.
And he saw that this market had the potential to grow way beyond what, anyone was anticipating at the time.
So being in the right place at the right time, but also having, the foresight to recognize it, to see it. What else did he consider crucial for long-term success?
Well, another really critical point is management's commitment to R&D. Essentially, is the company investing in innovation? Are they developing new products, new processes to stay ahead of the curve?
That makes sense. Can't just rely on one product forever, especially in today's world.
Exactly. And he points to Dow Chemical as a company that really understood this. But what's interesting is they didn't just pour money into research. They also applied the same rigor to training their sales force.
So they're not just making great products, they're also making sure that they can sell them.
Exactly. They knew that innovation without effective marketing, it wouldn't get them very far.
Right. It's one thing to create a fantastic product, but you also need to be able to, get it into the hands of customers.
Yeah.
What about the people who actually make those products? How important were employees to Fisher's assessment of a company?
Outstanding labor and personnel relations, he called it. He considered that to be one of the hallmarks of a well-run company.
So happy employees equal a successful company.
Yeah, he understood that happy employees are more likely to be productive, more likely to, contribute to the company's success.
Yeah. It seems so obvious now, but,
Yeah.
back then maybe that wasn't such a widely held belief.
Maybe not. And he actually highlights Motorola. He was really impressed with their commitment to investing in their people.
Motorola.
Yeah. They created this thing called the Executive Institute, which was like this internal training program to, cultivate talent within the organization.
So nurturing the potential that was already there.
Exactly. And through this program, they discovered all sorts of hidden gems, people with incredible potential who might have otherwise gone unnoticed.
That's pretty cool. But of course, we can't forget about the bottom line.
Yeah.
The financials. Did Fisher have any specific metrics that he looked at?
Oh, absolutely. Profit margins were huge for him.
Profit margins, okay.
Yeah, he believed that, sustainably high profit margins, that was a sign of a well-managed company, one that could, control costs, command premium pricing.
So it's not just about making a profit. It's about, like, how efficiently you can do it.
Exactly. And those high margins, they shouldn't just be a one-time thing. They should be, consistent over time, showing that there's a durable competitive advantage there.
Right. Sustainable. So, okay, a company might have a great product, happy employees, but what if they're, drowning in debt?
Yeah, that's where financial strength comes in. Fisher, he emphasized the importance of a company having the resources to fund its growth, without taking on excessive debt.
It's got to have a solid foundation.
Yeah, it's like, you can have the most beautiful house, but if the foundation is weak...
The whole thing's going to crumble.
Exactly. So a company can have a fantastic product, a brilliant management team, but if they're, burdened by debt, that can really hold them back.
Makes sense. Wow, we've only just scratched the surface here of Fisher's 15 points, but it sounds like he had a pretty comprehensive view of what makes a company successful.
He did. And all these points, they work together, creating a framework for understanding not just the numbers, but the underlying dynamics of a business.
Like putting together a puzzle, each piece contributing to the bigger picture.
Yeah.
But I'm curious, how did Fisher actually put these principles into practice? Did he have any specific investment strategies, advice?
He did, and that's what we're going to explore in the next part of our deep dive into common stocks and uncommon profits.
All right. Got a lot more to unpack here. Stay tuned because it's about to get really interesting. All right, so we're back, and we're going to dig a little deeper into Philip Fisher's common stocks and uncommon profits. Really want to kind of get into, how he actually put those 15 points into action, his investment strategies, all that stuff.
Yeah, one of the most kind of unique things about Fisher's approach is his view on dividends. He kind of went against the grain on this one.
Really? How so? I mean, it seems like everyone loves a good dividend.
He believed that, especially for these, younger companies, the ones that are really growing fast, reinvesting those profits, putting that money back into the business was much more beneficial over the long haul.
So it's like delaying that gratification. Instead of taking the money, now you let the company use it to, fuel even more growth down the road.
Exactly. He actually uses this great analogy of a farmer, rushing his livestock to market like as soon as they're sellable, instead of, letting them grow to their full potential.
Yeah, you might get some quick cash that way, but you're missing out on bigger profits later.
Exactly. And this whole long-term mindset, this is really a key theme throughout Fisher's book. He even had what he called the 3-year rule.
3-year rule, what's that?
He believed that investors should be prepared to hold on to an investment for at least 3 years, basically ignoring those short-term ups and downs in the market.
Wow. That takes discipline, especially back then when you couldn't just, check your phone every 5 minutes to see how your stocks were doing.
Yeah. It definitely did. But he understood that real growth, it doesn't happen overnight. Trying to time the market, jumping in and out of investments all the time, that's usually a recipe for disaster.
Yeah, you're probably going to lose more than you make that way. This reminds me of something else. That Fisher was known for his skepticism of the efficient market. The whole theory that all information is already reflected in stock prices.
Oh, yes, the efficient market hypothesis. It basically says that it's impossible to find undervalued companies because everything's already baked into the price. But Fisher, he wasn't buying it.
So he thought the market was kind of irrational, more driven by emotions and, people just following the herd.
Yeah, in a way. He believed that patient investors, the ones who do their homework and really think for themselves, they could find opportunities that everyone else was missing. The market wasn't always as efficient as people thought.
So he saw those opportunities where others just saw chaos.
Right. He actually did this really interesting experiment with his students at Stanford, had them analyze a bunch of stocks and try to predict, how they would perform in the future. And guess what?
What?
Their predictions, they were all over the place. Totally different.
So much for the efficient market.
Exactly. It just goes to show that even with the same information, people can come to very different conclusions about a company's value. And that's where the opportunities lie, according to Fisher.
For those who can think for themselves, do their own research. So we talked about taking that long-term perspective, reinvesting profits, challenging that conventional wisdom. What other principles did Fisher really emphasize?
He was also very aware of the power of perception, especially when it came to, a company's image the industry was in. He knew that market sentiment could really move stock prices, sometimes even irrationally so.
So it's not just about the numbers, it's the story the market tells about a company.
Yeah. Like
Yeah.
he uses this example of Motorola. Remember how their stock price jumped when they announced they were getting out of the TV business?
Yeah, even though that division was like a tiny part of their overall operations.
Exactly. But the market loved it. It fit the narrative, that Motorola was focusing on its more profitable areas. It was a case of perception totally overriding reality.
So Fisher believed that, to be a successful investor, you had to be able to see through the hype, distinguish between what the market was saying and what was actually happening with the company.
Right. Don't just blindly follow the crowd, think for yourself. He believed that by focusing on the fundamentals, not getting caught up in all the emotional ups and downs, you could make much more rational decisions.
All of this is super fascinating. But I'm also curious, where did Fisher get all this wisdom? What shaped his thinking about investing?
Well, he actually got into investing really young, started dabbling in the stock market when he was a teenager.
Teenager.
Yeah. Funny thing is, his father was a physician and he thought it was just gambling. Didn't approve at all.
Sounds like he had that entrepreneurial spirit early on. So did any particular experiences kind of, stand out as influencing his approach to investing?
Well, while he was working at a bank, he saw firsthand how important a strong sales organization was. You could have the best product in the world, but if you couldn't sell it...
It's worthless.
Exactly. He even spent time at car dealerships just observing the salespeople, noticed how some of them just had this knack for connecting with customers and closing deals.
It's interesting how he drew these lessons from everyday life, and applied them to investing. What about his own investment track record? Did he have any early successes that kind of, proved his philosophy worked?
One of his early investments was in Food Machinery Corporation back in the 1930s. And this company really embodied a lot of those qualities. He looked for, strong market position, a commitment to innovation.
So he put his money where his mouth was.
He did. And it paid off. And then his investment in Texas Instruments in the 1950s, that really solidified his reputation, as an investor who could spot these undervalued companies with huge potential.
Sounds like he was a master at finding those hidden gems.
He really was. And his success wasn't about, luck or timing. It was about really understanding business, human psychology, the dynamics of growth.
Wow. We've covered a lot of ground here. Scott, about the 15 points, his view on dividends, his own personal experiences. It's incredible how relevant his ideas still are today.
Yeah, it's really remarkable. His work has definitely stood the test of time.
But I'm guessing there's still more to uncover. Did Fisher have any specific advice for investors, practical takeaways that we can use?
He did. He actually provided a whole set of don'ts, things to avoid, and they're just as valuable as those do's.
All right, well, I'm all ears. Let's dive into those don'ts in the final part of our deep dive into common stocks and uncommon profits. Okay, so we're back, ready to wrap up our deep dive into Philip Fisher's common stocks and uncommon profits. And this time, we're flipping the script a bit, focusing on his don'ts for investors.
Yeah, these are like his warnings, the things he really wanted investors to avoid.
So not just what to do, but what not to do. I like it. Sets off the alarm bells. So what's the first don't on Fisher's list?
He says, and this is a big one, don't buy into promotional companies.
Interesting. Especially these days, it seems like everyone's chasing, the next hot startup, the next big
Oh,
IPO.
yeah, that fear of missing out, it's real.
Mm.
But Fisher, he was really cautious about these, unproven companies, especially the ones that are all hype, all marketing, but not a lot of substance.
So there's got to be more than just like a good story.
Exactly. It's got to be a solid business with real potential, a proven track record. He saw those promotional companies as really risky, especially for long-term investors.
So what were his concerns specifically?
Well, he pointed out that these younger companies, they often lack like experienced management. They don't have that solid foundation yet.
So they might have a great idea, but not the know-how to actually, execute it, make it work.
Right. And they might not have the financial resources to weather those inevitable storms, that every business faces at some point.
So he was more into those established companies, the ones that had, kind of stood the test of time, proven themselves.
Exactly. He saw those companies as a safer bet for long-term growth, for investors who are looking for steady returns, not just a quick buck.
Okay, makes sense. What's the next don't on the list?
This one might surprise you. He says don't overemphasize diversification.
Really? Diversification. That's
Yeah.
like investing 101, right? Spread your risk. Don't put all your eggs in one basket.
Right. And he wasn't saying diversification is bad. It's just he was worried that, if you spread yourself too thin, if you have like a million different investments.
Can't really keep track of them all.
Yeah, you lose that focus. You can't really dig deep into each company, understand its nuances, its potential.
So it's about depth over breadth.
Exactly. Really knowing your investments inside and out. And that goes back to his whole emphasis on research. He believed that by focusing your energy on, a handful of really exceptional companies.
But ones that meet those 15 points.
Exactly. You could potentially do much better than trying to own a tiny piece of everything.
It's quality over quantity. So what else did Fisher warn against?
Another big one is don't follow the crowd.
Sounds familiar. Isn't that kind of related to his skepticism of the efficient market?
It is. He believed that, the financial experts, the analysts, they're often slow to recognize like real changes in a company, whether those changes are good or bad.
So they're always playing catch up.
Kind of, yeah. They're reacting to the news instead of, anticipating it. And Fisher saw that as an opportunity. He believed that if you did your own research, if you thought independently.
We could get ahead of the curve.
Exactly.
So be a contrarian, be patient, and do your homework.
Yeah.
Right. What's the final don't on Fisher's list?
He says, don't try to predict the market.
Oh, man, that's a tough one. It's so tempting to try to, time those ups and downs, buy low, sell high.
It's really hard to do consistently, though, even for, the pros. Fisher saw it as a form of speculation, and it often leads to more losses than gains.
So stay focused on those long-term fundamentals, on those great companies, and don't get too caught up in those day-to-day market swings.
Exactly.
So if we were to kind of sum up all of Fisher's wisdom, all those do's and don'ts, into like one key takeaway for investors, what would it be?
I think it would be this. Investing is not about gambling. It's about understanding businesses. It's about finding those companies with true potential and then being patient.
It's about like thinking like a business owner, right? Not just a trader.
Right.
Well, there you have it, folks. We've gone deep, really deep into the mind of Philip Fisher, explored his 15 points, his unique approach to research, his emphasis on long-term thinking, and of course all those crucial don'ts. And if you want to learn more, we highly recommend checking out his book, Common Stocks and Uncommon Profits. It's a classic, packed with wisdom that's still relevant today.
It really is a timeless classic.
That's it for this deep dive. Until next time, keep exploring, keep questioning, and keep diving deep.